One of the problems many traders face is that they don't know where the price reaction will come from. Because of this, they enter at odd points and repeat a pattern of taking large losses. 90% of the trading videos trending on YouTube right now are about SMC or lousy indicators. If you watch about 10 videos on this concept, you'll realize that despite analyzing the same asset, they all present different perspectives and results. This happens because the concept itself is highly subjective and everyone's depth and level of learning vary. Why should we stick to such subjective and difficult trading methods? In my view, it's all a complete waste of time. Of course, there are traders who make profitable trades using those concepts, but they are a tiny minority, and it's likely their own investment philosophy is integrated into it. Otherwise, they claim to teach trading methods just to get customers to pay for expensive courses or write books on their own methodology to drive paid subscriptions. In other words, they aren't traders, they're people making money through marketing. Beginners are especially prone to these temptations, but you must never spend money on them. Instead, strive to understand the market structure. I guarantee you, this is the fastest way. Let me show you some proof. In last week's briefing, I correctly predicted most of the market movements. If you don't believe me, here's a short summary of that briefing. In the first briefing, I mentioned a market decline and the market subsequently dropped to the bottom of the channel. The second briefing stated that the market would show a temporary uptrend but would soon reverse into a downtrend. In reality, the market failed to reverse upward and turned into a downtrend. The third briefing actually predicted a downtrend even before Trump's speech. Since the market was rising at the time, many traders were hoping for a ceasefire or expecting positive news. However, the market showed a downward trend. Such briefings were possible because I know which price the market wants to reach and observe if it moves according to the liquidity created by market makers. The liquidation map is a very easy indicator to use for identifying this. To be honest, you can trade effectively with just this indicator alone. The brightly colored areas are called liquidity zones, where the leveraged positions of traders with insufficient balances are forcibly liquidated. When a flood of counter trades from traders occurs, market makers can easily execute their large orders using that abundant liquidity. In other words, market makers want to move toward these zones. They must reach the liquidity zone to get their volume filled. This works the same way not only for crypto, but also for various assets like stocks, commodity futures, and index futures. For crypto, you can easily check it on CoinGlass, and for stocks or futures, you can use brokerage platforms like Bookmap. Since the market moves toward liquidity, it's essential for beginners to understand this concept. Now let's take today as an example. It's taking a breather after hitting a major liquidity zone. With large liquidity zones at 70,000 and 72,000, there's a high chance it'll extend there. I'll draw a channel on the chart and plan for a scenario where it extends to the upper boundary. There are two possible entry scenarios here. One is betting on a drop after the candle hits the upper channel, and the other is entering a long position on a pullback and holding until the upper wall. Personally, I think the uptrend will continue, but since the video is getting long, I'll stop here for today. If you're a beginner, don't get lost in charts. It's much faster to study real data and why the market moves that way. Don't get too caught up in news or charts. Try to figure out what price the market is actually looking for first.